We're now ready to go on and look a little bit further into some of the rules for the game or some ideas for the game. And this presentation is entitled Some Additional Ideas for BSG. And this is primarily a reflection of what I've learned by playing this game over a number of different sessions, and not anything that you're going to find in the rule book. First of all, very important, be aware of time deadlines and get your data input before the deadline. If you miss a deadline, you're toast. There's no way I can't get the toothpaste back in the tube. So what you must do is make sure that you follow the time schedule, and you'll find under information a file that gives you all of the schedule dates for all of the events. That's date and time of day. I've got everything set to the events typically will go off at 11 p.m., which will give you at least another hour before you get ready to go to sleep to read the results from the immediate decision that you're making. But it is just vital that you hit those dates, because what will happen is that the system will take the decision you made last round and apply it to this round, and the world has changed in that one go-around. So just make sure that you hit the date, otherwise you'll be thrown under the tires. Now, in order to get ready for this, as I had told you in one of the earlier sessions, you have to make about 150 discrete decisions on every round. And to do that initially, you aren't going to understand what you're doing. That's why we'll have a trial decision where you can give it your best shot and then review the results before we begin on the graded portion of the game. You're probably going to spend about 6 hours making that first decision. And this may continue on for the second and third decision, but about that time you're going to begin to understand it well enough you can cut that time investment down to about 2 hours. And certainly by the end of the game, you could very well put your decisions in 2 or 3 rounds ahead of time, because you will understand where you're going and what your next decision and the decision after that should be. And again, I refer to the chess game, that's how you have to do it to be successful. Use a PC laptop, or if you've got a Mac, make sure you've got Excel on it, because this game is based on Excel. You can use the computer in the computer lab if you are on campus, but don't try and use any of the computers that are in the individual classrooms, because you're going to run into firewall problems and the inability to communicate with the game. Slide number 4 says, pick one person to do data input, and it has a little star up in the corner. If I have something that's important, I put a star on that slide so that you're reminded that this is important. You should have one of your team members be the data entry person, and while you work on and agree as to what you're going to do for the decision set that you've got, just make sure that that data entry person is the only person that puts the data in. I had a situation recently where one member of the team got a great idea late at night before the decision was to be finalized. And even though his team had all agreed on the direction they wanted to go, he thought the thing to do was to borrow a bunch of money. And so he put in a decision that allowed them to take down a large bank loan. And it just emasculated the team. He was a stand-up guy, so the next morning he wrote me an email and wrote an email to his teammates and said, I screwed up, I made a mistake. But he learned for all the rest of the time he was in that game, don't go off on your own. Make sure that the data entry person is the only person that puts data into the computer. That's not the smartest person. It's not the most aggressive person. It's the person that can type the best. And just follow that as a direction. It's a good idea to make a copy of all the entries you're going to put into the system. If for some reason you get cut off in mid-entry, it'll make it easier to get back into the system and get your decision finalized. The next item I have here says you may change entries and resave up to the moment the decision is due. And again, I've got a star by that. This game will give you, one of the things it gives you is a suspected or suggested ending cash balance based on the decisions that you've made. This is the last piece of the last report. And you want to be able to, you want to watch that because you want to make sure you don't run out of money to begin with. And what it allows you to do is to try different scenarios and see what the impact would be on profit and cash. You can do as many scenarios as you wish to do prior to the final save at the, just before the decision is run. So recognize you can do this as much as you want to with complete security that you're not going to run into a problem. And I would suggest as you go through the game, if you think, well, you know, I want to make sure I don't run out of cash, you might try running a scenario where your sales are, say, 10% lower than what you expected them to be, and see how you would come out if that final result occurred rather than the one you expected to see occurring. Also recognize that the scenarios that you run and the results that are displayed assume that there's no other competitors making corresponding decisions. The computer can't anticipate what the other guys will do. So you need to build in this element of uncertainty to recognize the fact that your competitors are going to be making decisions with the objective of taking the same market that you're in. So it's helpful to do that. Now, I want to ask you if you're a super achiever. I'm going to show you a technique that's been used for hundreds of years, and it'll work for you not only for this game but for life. And you'll notice here a picture of Leonardo da Vinci and Wolfgang Amadeus Mozart, and they had something in common that you can have in common with them. And that was that whenever they would do something important, they'd write down what you expect will be the result, and then go back and see what the actual results were and how close that was to what you anticipated was going to happen. And this is a very, very good technique. So keep a written record of everything, all the decisions that you make, and then ask the question, did things turn out the way we expected them to? And if not, can we discern why they didn't turn out the way we expected? Peter Drucker, and I'm going to mention him again a little bit later on this morning in one of my lessons, was a great management thinker who worked down at Claremont, just down the street from Cal State San Bernardino. And he said he'd used this technique for 40 years. And you can look at anything that he's written and see the brilliance that this man had. But this is a tool that he had that you can use as well to make yourself a better business person and a better person in general. So in slide 8, I want to remind you that the data entry sheets forecast your financial results based on your inputs. This does not take into account your competitors' plans, and the actual results will vary widely from your forecasts. So when you see your results being entirely different, you want to go find out what did the competition do, how did that impact and dull the strategy that we were trying to implement. So you want to get, you won't be able to do this initially, but as we go a little bit farther down the course here, you will have, you'll learn enough to be able to plan your strategy more than one move in advance. And again, this is just like chess. You want to be able to plan 2 or 3 moves ahead. And I want you to consider this as a learning exercise. Yeah, we all want to get the good grades. There are ways out there you can beat the game. But that's not something you can take to the marketplace and use. What you can use is what you've learned. So I want you to treat each decision round here and the discussions you have about how you're going to implement your strategy as learning exercises rather than just exercises to win. The next slide, number 10, has a star. So I want to remind you, to have any chance of success at all, you have to have a definite, consistent strategy. So if you choose to go with a low cost, low price, be sure everything you do supports that decision, not only in the next round, but in all the rounds in the future. If you choose to go with a differentiation strategy, make sure all of your decisions support that baseline decision and that you don't wander off into Never Never Land. In order to be able to be effective with that, you've got to read and study all of the reports. All of the secrets of the universe are in those reports. And then study your projected, actual and projected balance sheet, and the thing that you want to watch for is keep that inventory under control. It can get out of control very quickly. And if you run into that situation, you can give me a call and I'll show you how to fix it. You all are young, and I'm old. I can't afford to take risks anymore, because if I make a mistake, I don't have a retirement package. You all are young and you can rebound, you can recover from bad mistakes that you make. So think about this game from a perspective of taking some risks. These risks cost you nothing. If you have, of course, if you have had a background where you've had some bad things happen to you with having taken risks, you may want to take a more conservative approach. But recognize that risk-averse teams, and those would be those who choose not to use debt as a financing option, are going to build up lots of cash, they'll be successful, but they will not be in the top of the class. You have to be willing to take reasonable businessman's risks. Now, the next slide shows you two different approaches with leverage. And if you look at leverage or lack of leverage, and what I've created here is two different scenarios. And if you look at the leftmost of the two, it shows what would happen if you had no leverage. And it shows a company that has zero debt and $100,000 in equity. It projects an income of $20,000, zero interest expense because there's no debt, and therefore a net income of $20,000. If you look below that, it says return on equity, and the return is the $20,000. The equity is the $100,000 that was mentioned above. The return is 20%. Cash from operations, it's the same $20,000. There's no other places that that money would be siphoned off to. Of course, there's always taxes, but we're ignoring that for this particular exercise. Since there's no debt reduction, because there is no debt, the ending cash balance is $20,000. On the right-hand side, I show what would happen if you increased your leverage. And here we're going with a same scenario, but in this case, of the total financing requirements, 50% is done with debt, that's $50,000, and $50,000 or 50% done with equity. Same $100,000 available. In this case, the income's the same, $20,000. But you would have interest on the debt, so I've put in a very high rate of 10%. And that means that you'll have $5,000 worth of interest, so that the net income is going to be $20,000 minus 5, or $15,000. The return on equity, though, is now $15,000. That's a smaller income, divided by the equity, which is $50,000, a smaller equity base, so that the return on equity is 30%. Cash from operations, $15,000 instead of $20,000. Debt reduction, I said let's pay this loan off in 10 years, so that's $5,000 worth of debt reduction, so that the net cash generated is $10,000 versus $20,000 in the first scenario. But recognize the $10,000 is the same return on, in relationship to the equity investment, 10,000 divided by 50, is the same as in the first scenario, the 20,000 divided by 100, 20% for both. So you can, what you're going to find, but you obviously are much better off, because you will eventually pay out that debt and be able to maintain the higher return on equity. That's important because that's how the marketplace is going to evaluate your stock. And what you have to consider doing is, as you go through this game and your equity keeps increasing as you take your earnings for the year and reinvest them back into the company rather than paying them out as dividends, what will happen is that your equity base will get higher and your return on equity, even if your performance rate levels are the same, will begin to decline. And you've got to find a way to keep those return on equity numbers up. So bottom line here is take calculated risks. That's quite different from being rash. And the guy who said that was probably the most risky guy in our military history, George Patton. So let's take a break at this point.